Welcome back to SCR Unfiltered, everybody. I'm Bill Faith, founder of Build Short-Term Rental Wealth, investor, blah, 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 blah. I've been drinking a lot of this lately on my fitness journey, but this is something I'm pretty passionate about, so I'm going to have a little dip of Diet Coke, and then we'll dive right in. I want to talk about not effing up your portfolio with cost segregation studies and 1031s. And I want to give you a little bit of context behind that statement first. A lot of you are effing up your short-term rental portfolio because a lot of you are just investing for the cost seg benefit. And that's not really the purpose of this podcast. So if you say, Bill, I've heard you say that before. Yeah, I get it. That's not the purpose. The purpose here is to understand what happens when you don't have enough financial wherewithal behind the acquisition of a piece of real estate. And it's a position that I was in when I first started investing into real estate. I didn't have the assets, the cash that I have today. So because that story, because that financial backing is bigger for me today at 50 than it was when I was 24, 25, or even 30 or 35, I can make different moves. I can be a little bit more aggressive. But even today, I only have 30% of my portfolio is encumbered. And that's the term that I want you to remember, encumbered. And there's three big things that we do as investors to encumber our real estate, specifically short-term rentals, because of the loophole. Number one is a 1031. I view, and this might come as a shock to many of you, that I am very conservative in how I spend my money. I'm very conservative in my investments. I am rocket fucking fast when I am making decisions. I am rocket fucking fast when I am underwriting a property because I don't want to let something that is valuable slip through my hands. But I am never rushing, and I am never sitting in a place from extreme urgency. It's like the great John Wooden, I think the greatest coach of all time, definitely the greatest basketball coach ever, talks about moving swiftly, moving fast, but in control. And here's what happens with 1031 exchanges. Too many people are trying to move too fast, and they're just looking at this as a tax deferral component, which is what it is. But they don't have, when you don't have enough cash, when you don't have enough assets, when you don't have enough financial wherewithal behind that 1031, and then the market takes a 20% hit, and you or a spouse lose your W-2, or your primary business takes a 30% hit in revenue or profit, and you have to access that cash, you're screwed. For that reason, that's the number one encumbrance. I look at using a 1031 as, wow, that cash is going to my children. I might as well just put that someplace that I will never touch for the rest of my life, and that's going to be left to Gentry and Oakley. 1031 is number one. A lot of you are using it recklessly because you're 27, you're 30, and you see that you can tap into $100,000 in equity on your 10% down, $500,000 property you bought in 2021, and you're going to 1031 so you can, move that $375,000 property to a $550,000 property and do another 10% down. And you got $8,000 in the bank. That's reckless. The second thing that I want to talk about is the cost segregation studies. I love them. I've been taking advantage of them for 3 years. We're at 80% today. I bought one property. I'm closing here in the next couple of days on my second property, both in Montana. One's the river house that you've seen. The other one is a condo. Why did I buy the condo? Bill, you always said you'll never buy condos. I bought it because I found one that's creating a new space. It's going to be turned into a super condo, a super property. It's going to cash flow positively. Am I going to do 30% cash on cash return? No. Will I do roughly about 20%, maybe 21, 22% in the first year? Yes. Is that good enough for me when I factor in the cost seg benefit with 3% land value and 97% dwelling value on a $950,000 property with all the other ancillary benefits behind it? Yes. The historical appreciation? Yes. Now, if I cost seg that and I was to sell that in a year or two, or probably even 3 or 4, like within the first 5 years, then I really need to understand what that IRS is going to recapture on my accelerated depreciation. Because if I sell that property for 1.2 million, a lot of people think, well, 950 subtracted from 1.2 is $250,000. What they're not factoring is if I sell that in year 2, man, there could be 100 G's, 75, 100, maybe 125,000 recaptured by Uncle Sam. So there goes half of that delta. Now let's factor in closing costs, commissions for the real estate agents. I could walk out of there with a big donut if I have to pay the recapture. That's the cost seg. The cost seg is amazing what it can do for us, specifically if you're a high income earner. I do believe that at 80% value this year, those of you that were cost segging $500,000 properties or $400,000 properties, probably not worth it at that point to try to get a $90,000 net value and you fall into the 32% or 28% tax bracket and you're only getting a $25,000 or $30,000 tax benefit. I think there's other ways to accelerate your depreciation potentially than have to do that, especially those of you that are selling, within 4 months, 6 months, and then you're going to buy another property and do a second cost seg within the same year. So that's going on to your same filing for 2023 taxes in 2024. That to me is risky. That could really flag an audit from the IRS. We've talked about 1031s. We've talked about cost segregation studies. The third one is, and this is really the trifecta when they're all put together, is the DSCR loan product. I want to let you know I've done DSCR loans in the past. Actually, my Beach Mountain property that I sold in May was a DSCR product with the lender. And it was fantastic. It was like 4.25%, 4.5% interest rate, 30-year 30-year AM on a 40-year note or 40-year AM on a 30-year note. I can't remember exactly. But it had a 3-year prepayment penalty, and I sold it a year later. So I had to pay 2 years of the recapture. 2 years on a prepayment penalty. Did I cost seg it? Yes. So if I cost segged it and I sold it like 13 months later, what do you think I had to do? I had to 1031. That recapture was about $21,000. That is something that most people aren't factoring in because a lot of people are 1031ing out of a property, then they're selling property 1, 1031ing into property 2, then they're doing the cost seg. A lot of you don't have the financial wherewithal to qualify for Fannie, Freddie, or a commercial loan, so you're doing a DSCR product and you're doing 3 to 5 year prepayment penalties. Man, if you have to sell that property, you're screwed. If you have to sell that within 3 years, you're in trouble. So here's the crescendo. That is why I only have 30, and I'll never go over 35% of my portfolio over here in this bucket. Yes, I'm using hand gestures. If you're watching on YouTube, you know what I'm talking about. 35% max. I'm at about 30% right now that has any one of those encumbrances. And there's one property that has all three. That's my Banner Elk property. 1031 into that property with about $400,000 in 1031 funds. Cost seg that it was 1.6 million, got a huge cost seg benefit off of it. And I did the loan through the lender. And I'm in year 3 right now of going into year 3, almost to year 3. I guess I'm just over 2.5 actually, with a 3-year prepayment penalty. So once I clear past essentially the end of February of 2024, then the DSCR falls off of that encumberness. So that means 2 more years to get through the major component of the recapture in that 5-year period for the cost seg benefit. But I have 1031 funds going into it just over $400,000 in cash. If I was to sell this property, like especially now within that 5 years, I would probably eat up the majority of my funds if I did not 1031 from the previous basis that went into the profit, the positive basis, to roll into Elk Lodge, roll into the Banner Elk property. And then if I had a recapture of a DSCR product or a recapture of a cost seg, even in year 3, it would make no sense to sell. So, what's the moral of the story for today's podcast? The other, before I get into that, the other thing that plays into this is your age. I was talking to a gentleman today, completely different age, like Ryan Bakey, age 25, completely different than me at age 50. But there's that middle ground. What do you do between like 30 to 40? All of those things, how old you are, how much cash, whether it's in 401k, stocks, bonds, cash, money market account, whatever it is, but it needs to be some form of liquidity that you can access, not real estate to sell, in my opinion. How much cash you have behind that investment clearly dictates and helps you mitigate the risk of encumbering your properties. So the more cash you have, the more encumbrance I would be comfortable with you making. But the less cash that you have, or the younger that you are, the least amount of encumbrance I want you to have. If you're 25 just getting started, 1031 should not be on your mind. Class A could be if you're a super high income earner, but you better make good fucking investments. That means tremendous underwriting so you don't make a mistake, and you better factor that in. So nobody's talking about factoring in long-term recapture of cost segs, DSCRs when you're running a pro forma. I believe everybody in the underwriting process, especially with how uncertain today's economic conditions are, we should be looking at what happens if we have to sell this property 12 months, 24 months, 36 months from now. What is it going to cost me? What am I not seeing? Either 1031, DSCR, or cost seg. Do that and mitigate your risk as you're investing and building out your super portfolio. Thanks for joining me on this episode of STR Unfiltered. As always, please hit the subscribe button. Please leave a review. If you're listening to this on Spotify, Apple Podcasts, wherever. If you're watching this on YouTube, hit subscribe. If you have a comment, just leave it down below. I will personally reply to you. Happy hosting. Have a great day, everybody.